And 72% of the time the market goes up. And the answer came to me. And that's what I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast today. Okay, so everybody's excited today. The market's excited. Why? Because the TV jibber jabbers are getting them excited. And the reason why they're getting everybody excited because they're saying, hey, listen to what I got to tell you about some fundamentals. Oil is down, man. Oil's down. That's good. So bye. War's over. Bye. Well, anybody that listens to that and starts chasing stocks like they're doing today, they're going to give all that back. And that's not how the market works. Remember, it's institutional money that fuels the stock market. We need that money to come in. If that money doesn't come in, then all these gains just go away. So the idea that in March 20th, we were at $100 on oil, and then we dropped to March 23, $84. Okay, then we went back up to $90, and now we're back down, I think, where we are today. Today we're down back about 4 right now, something like that. So the idea, or 91 here. So we've been in this roller coaster of oil prices going up and down. First thing, you're not going to hold any gain in the stock market unless oil prices start stabilizing. But most important, besides that, the most important thing of all is we need the 10-year Treasury yield to come down. It's too high. And we need a trend in Treasury yields coming out, just not 1 day or 2 days or pop here, pop there. We need a very strong trend. I'll show you on my chart. You can see my chart here. What Treasury yields need is a pattern, a trend. And when we get a pattern of lower highs and lower lows, that's when you start seeing the institutions pouring money into the stock market. We're not getting that. The reason that right now we have higher lows and higher highs, that's not working. So whatever rally we have today is not sustainable. And we can see that this morning, how high the Dow was earlier this morning, and now look where it is. So that's one of the big things is the 10-year yield. You got to get the 10-year yield down. It's so important. And also, remember, when the 10-year yield comes down, the dollar follows the yield, and the dollar will come down. And we need that too before any rally will sustain itself. So right now, this rally we're having is not going to sustain itself because the most important thing is to get the 10-year Treasury yield to come down. It's too expensive. And why is it expensive? Because oil is so expensive, and people in the bond market are saying we're being punished with inflation. And Powell came out yesterday and saying, gee, we made a mistake. Inflation is higher than we thought it was. So always remember, forget the fundamentals. Today, this rally, forget about it. It's not going to last because the 10-year Treasury yield needs to drop. It needs to pull the dollar down with it. Because here's another thing. Because 40% of the S&P 500 companies or revenue, 40% of the S&P 500 revenue comes from overseas. So that's why, again, you got to have a weak dollar. It'll boost earnings, which boosts stock prices. So we don't have that right now because unless the yield comes down, the dollar's not going to come down, and that means that 40% of the S&P 500 stocks, revenue rather, that comes in, is not going to do well. It's going to be in trouble. Not going to get good earnings. So you see how yields are so important because the yields are connected to the dollar. The dollar's connected to the Europeans. The if the dollar's high, they're not going to go and take their currency in exchange for dollars to buy gold or buy anything or buy bonds. Matter of fact, about 90% of all the purchases of bonds come from Europeans. So when I was watching today, all these jibber jabbers in these suits on TV telling everybody, well, bye-bye because oil's coming down, war's over, what a bunch of nonsense that is. You're going to give all that profit back. Now, there's another thing that's very important. Besides the 10-year Treasury yield, the dollar coming down, so at least and remember, the dollar coming down is so important because we need those European buyers to buy our bonds. And we need, as I said, the S&P 500 companies that, contribute 40% of their earnings or profits by selling stuff overseas. We need that revenue. Now, what's the other big important thing? Well, the next thing we need to sustain any rally, we need to have the small mid-cap stocks participating. That's not happening. Remember, the yield, 10-year Treasury yield, is truth serum, and IWM is truth serum. That's the only two places you can go to find out the truth. When you have the question, what do you think the market's going to do? That's where you go. You don't turn on CNBC. You don't turn on, Fox Business. You don't turn on any of that stuff. Go to the yield, 10-year yield, go to IWM. Now, IWM is most important of all because it's the first warning signal when something is wrong. So when something starts to crack under our foundation, we'll know when IWM starts breaking, starts rolling over. And if you have IWM starting to roll over before the S&P and the NASDAQ, that's signaling that there's something wrong. There's some real economic stress. So right now, IWM is weak. You can't have a weak IWM and you think the market's going to go up today, it's going to sustain these. It may go up 2 days, may go up 5 days, I don't know. Because we get all kinds of stories. Remember, Wall Street's great with fundamentals. That's why they still use them, because they can create stories. But that's not what holds rallies. Now, the other problem is this. IWM, as I said, is causing a problem for us right now. Because IWM, as I said to you the other day, it was right at the 200-day moving average. And the 200-day moving average is most important because the 200-day moving average is a point where the big institutions, if they watch IWM break through the 200-day moving average, they dump hard all their stocks. They dump hard. That is when the other day, when Trump came out with a story, oh, by the way, we're going to stop bombing Iran for 5 days. That was all to make sure that IWM did not break through the 200-day moving average. And the minute he said that, you see what happened? IWM went right back up, away from that 200-day moving average. He was scared to death it was going to break. Trump knows how to trade. His whole family trades. They know what it means when IWM is ready to break through the 200-day moving average. They know that the Dow would dump like crazy, and that would really hurt. Now, here's another thing that has to happen. Banks. Banks are the center of our financial universe. Now, and the Fed rate has to drop. The Fed rate right now is around 3.75. And that's why Trump has been so mad at Powell this year, because in order for the yield curve to be in place, where banks really feel aggressive, they want to go start loaning money, they see demand, they want GDP growth, they want to loan, you got to have this setup. They call it the yield curve. Think about this, so simple. They got to see that the short-term Fed rate's at 2. Now, the long-term yield can be at 4.5, 4.39. Doesn't matter. It's that Fed rate that has to be at 2. So where we are today is we don't have a setup for the banks to start loaning. They're not going to loan. Why? Because we have the short-term Fed rates at 3.75. That doesn't work. So when you have the long-term 10-year yield at 4.39, and you got the short-term Fed rate at 3.75, You got to get that 3.75 down to 2. If you get that, because right now, if you want to call it the yield curve or the curve moving up, we're only up 45 basis points. We got to get up to 250 basis points. Once you get up to 250 basis points, then the banks want the loan. But we're nowhere near there. We're at 45. That's really bad. Now, the other thing we need, that's why I was laughing this morning. I'm watching the market going up. Everybody's giddy. The guys on CNBC, all giddy, MSNBC, all the financials. Oh, here we are. We're on our way back again. What? You haven't got any of the components that will hold this rally. What are you talking about? Now, one other component you need in order, because remember, all the TV jibber jabbers, all the Wall Street suits have been lying to you for so long, making you believe that these stories they tell, these fundamentals they use to tell stories, is what drives the market. No. What drives the market, the fuel, remember, is always the institutional money. The 13 institutions that have powerful balance sheets, with powerful money. That's what's going on. That's what we don't have that. So we're missing also too the M2 money supply. What's that mean? Well, when you got the M2 money supply, all that means is how are checking accounts doing? How are the deposits? Are they strong? How about our savings? Are those strong? How about retail money market funds? Are those strong? How about the small-time deposits like CDs under 100,000? Are they strong? And the answer right now is no. They're terrible. They're weak. So what's that tell you? That tells you the economy is very, very weak. So when that M2 money supply is weak, is because all of those things, checking accounts, savings accounts, retail money market funds, CDs, people are taking money out left or right just to pay their bills and medical expenses. So when you don't have a strong M2 money supply, you're screwed. So again, just so you understand, Wall Street doesn't want you to know any of this. Just like, for example, I laugh about annuities. Oh, annuities, terrific. You'll never lose money on the way down. Never lose money. You only make money on the way up. You'll never lose money in the stock market on the way down. Never. Well, what they don't tell you, like I said to you yesterday, the dirty little secret's there. They don't put your money in the stock market. So you give them $100,000. They don't put that money in the stock market. They don't tell you that. They put it in the bond market. And then we have the largest skimming operation in the world. Because let's say you get an 18% return. So you take the $100,000 and you give it to the bond market. You give it to these, you give it to these annuity people. They don't put the money in the stock market. They put the money in the bond market. And that's why they can say you don't lose money on the way down in the stock market, because they're lying to you. They don't put it there. But the worst thing is, you get an 18% return, the annuity market, the insurance companies, take all of that except for 4%. You only get 4%. And out of that 4%, you still got to pay fees. So I'm just saying how they just don't tell you the truth of what's going on. And nobody's telling you the truth that this market today is not sustainable. If you're out buying today and chasing stocks, it's not sustainable. Because the most important thing is that 10-year Treasury yield has to come down. It's got to come down. But it's not going to come down as long as oil is above above $70. It won't come down. You got to get oil at least around $70. So unless that happens, the 10-year Treasury yield is going to stay high. You're also not going to get the banks lending unless the Fed rate goes to 2%. Right now it's at what, 3.75, something like that. It's got to get to 2%. So unless you get the Fed rate to 2%, the 10-year Treasury yield, you got to get down. And to get that down, you got to get oil down below, say, $70, $75. And right now, none of that's happening. So I don't give a hoot that the oil is around $80, $90. It's not going to work. So you're screwed with a 10-year Treasury yield. You're screwed with the Fed rate. Banks aren't going to loan you. So we have no growth. So between our banks and our 10-year Treasury yield, there's no growth. And IWM is the truth serum that's telling us there's a real problem underneath our economy. It's cracking. And because IWM, watch that. If that goes through the 200-day moving average, there's real trouble. So that's how the market really works. Nobody's telling you the truth, but we do here at Phil's Gang. Check us out.
Are you nuts?